we're trying to accomplish is really what Buffett's accomplished. But instead of starting with a textile business that was going out of business, Howard Hughes is a company that basically builds and owns cities. A very unusual public company, one that has not been recognized, I would say, properly by the market. Like Buffett, is very cheap. And so we own a big stake in the company, and we're in the process of either buying or building an insurance company. And the plan is over time to compound at a high rate over a long period of time, buy companies as opposed to buy stocks. We'll buy stocks in the insurance company portfolio. One of the interesting things about Berkshire, there are insurance companies that do a good job in insurance, and there are investment firms that do a good job in investing. What's unique about Berkshire is inside of Berkshire is one of the world's most profitable insurance companies, but where the assets of the insurance company are invested in common stocks.
So this is very important, that if an insurance company is on its own, it's got all sorts of regulations about how you can invest.
Yes.
But explain to us how, if it's owned by a company, you have a lot more flexibility.
That's true. So the regulators set kind of minimum capital levels, but the relevant measure is really how the rating agencies think of the business. And that affects, your ratings are critical. No one's going to buy insurance from you unless you're a highly rated enterprise. If you're a pure play insurance company, you're much riskier than if you're part of a diversified holding company. So the benefit that Buffett has brought to his insurance subsidiaries is this parent company that is not directly exposed to the insurance industry and is highly diversified with profitable kind of good businesses. So with that kind of credit support and running a relatively low leverage insurance company, they're writing a relatively small amount of premiums relative to the equity of the insurance company, he's given a lot more flexibility investing the assets of the insurance company. And our business plan is the same. So we own 47% of Howard Hughes, Pershing Square, and Pershing Square itself is very well capitalized, about $30 billion of assets controlling this 47% stake in the company. So Howard Hughes has the benefit of a rich parent, so to speak, supporting it. Howard Hughes itself is a very good business with about $5 billion of equity capital. And then we started an insurance subsidiary in the context of Howard Hughes, and we have the similar kind of flexibility as Mr. Buffett does to invest the assets. If you look at the 21-year history of Pershing Square, without fees, it's been about a 23% compounded return. Since we've had permanent capital, it's been about a 27 or 28% compounded return over the last 8 years. So you take our investment track record and you combine it with an insurance executive who can build a profitable insurance company, and you make money on both sides. You make money on the liability side of the business, the insurance business, creating low-cost liabilities, and you make money on the asset side. And that's how you can compound at a very nice rate over a long period of time. And we're going to use Howard Hughes to follow that playbook.